All right, I was going to do something completely different today. A lot going on with the markets, Russia, Ukraine, inflation, energy prices, all kinds of things going on. And we were going to talk about some of that today. But I recently gave my email, which is andy.gersher@odyssey.com. And again, that's andy.gersher@odyssey.com. That's Odyssey, AUDACY.com. I recently given out my email, and I got 3 emails asking about the Dow theory and about the levels we've been watching. The Dow theory went bearish and testing a level we had been watching for a while. So we're going to answer those emails, and we're going to give the people what they want. I'm Andy Gersher, and this is Gains. All right, bringing on Chuck Carlson, CEO of Horizon Investment Services and publisher of the Dow Theory Forecast newsletter in Hammond, Indiana. He's also author of the book Winning with the Dow's Losers. Always great to have you on the Gains podcast, Chuck.
Well, thanks for having me, Andy. I appreciate it.
I actually got a couple of emails. I was going to do something different today. And, Chuck, I got a couple of emails asking about the Dow theory specifically. And so I was like, we're going to just have to cover this because there were some levels that bounced around and there were a lot of questions. I got 3 emails. So for those who emailed me out there, thanks for the questions. And then hey, Chuck, we got to give the people what they want. So,
that's right,
so let's
Absolutely.
talk Dow theory. There were some questions about where we go now. So just to kind of recap the Dow theory, the last week or so, and Chuck's, an expert on the Dow theory. That's why we go to him to discuss. Chuck, you were telling us about this Dow industrial level of 34,022.04. And that was a level we had been watching for a long time, and we were looking for the Dow industrials to close below that level, indicating that the Dow theory had turned bearish. And we've seen the market all over the place. Well, it did pop over that one level on a close that we had been watching after it had already, given us the signal. And I think the big question is, what does that mean, if anything? So just kind of take it from there, Chuck.
Okay. Well, again, just to kind of briefly recap. So in the Dow theory looks at the movements of the Dow Jones Industrial Average and Dow Jones Transportation Average, and from those movements discerns whether the market's primary trend, the trend that typically lasts 8 to 12 months at a minimum, whether that trend is bullish or bearish. As Andy mentioned, we had been on a bull market signal, but there was kind of a bit of danger in the sense that the Dow Jones Transportation Average did go to significant lows in January. Now, that was not confirmed immediately by a similar decline in the Dow Jones Industrial Average. And one of the tenets of the Dow theory is that you need confirmation of both averages in order to affect a significant signal change. So we didn't have that. So as Andy mentioned, we had been waiting and seeing, and there were a lot of days in there where the Dow Industrials was dancing below that December 1st level of 34,022.04. But it didn't close below that. Then it would rally, and then it would kind of come down intraday, but it would hold that. But finally, it did go below that level on Tuesday, February 22nd. It closed below the 34,022.04, thus changing the primary trend from bullish to bearish. So the question is now, what's next? Where do I look? What's the point to be watching? Well, when you have a clear kind of signal change, kind of an all clear sign, that basically kind of flushes out everything that happened up to that point. So that 34,024.22.04 level no longer now is significant in a sense where we kind of start, you start the clock over.
So as soon as you broke through that level for the confirmation, because you had mentioned in January the transports had already hit that level, the industrials finally hit that 34 22.04 level on the close, indicating that the Dow theory is now bearish. That wipes out everything, right? You're starting with a clean slate.
Correct.
Okay, so
and so now what you're looking for at this point is, because it's bear market, you're looking for now the next significant low point to be established here, both in the Dow Jones Transportation Average and the Dow Jones Industrial Average, and that oftentimes takes a little bit of time to for the downtrend to end. And if you look at the industrials, for example, yes, we did have a pop above that 34,000 level momentarily, but it's not unusual, right, when you have bear market, a change in the trend to a bear market, that you get these kind of reflex pops. I mean, as you know, during bear markets, there's always kind of bull market rallies, or short-term, not bull market rallies, but bear market rallies, where you get these secondary corrections. A lot of times they're driven by short covering, for example, and we saw that last week, where you had a lot of people on the short side of things, and they tended to cover, and when they cover vigorously, you get those kind of 800-point moves like we saw on Friday. So it's not unusual that you have a market then, kind of rally following an immediate bear market signal. But typically what happens is that that energy that drives that very, very short-term rally dissipates, and then the market kind of subsides and comes back, which is kind of what happened today. And, the Dow pulling down and making now, coming back down to another level that's below the level of that 34,000. So, what we're waiting to see is kind of where this current downtrend in both the industrials and transports kind of bottoms out. And
is there a time frame involved? I mean, this doesn't happen in a day, right? I mean,
right.
Yeah.
And that's where a bit of the art comes into play here. There isn't exactly, a timing issue. If in fact the low point in the industrials, which is the low point close, was the February 23rd close of 33,131. So we're above that right now, even with today's decline. If you and I have a conversation 3 weeks from now, and that low is held, and most importantly, we've had a more significant rally, somewhere around 3 to 5% off that level, then I would feel comfortable saying, yeah, that's probably the next low point that we're going to watch and see how the market responds to that low point.
Okay.
But it's to me, it's too soon yet, in a sense of, we haven't gotten to that point yet, and we've only had a few days, and typically, these things can take, 3 weeks, maybe a little bit longer to pan out. So.
Real quick, though.
That's kind of, again, where the art comes in. So the fact of the matter is, we had that February 23rd low is still the low. We had some pretty aggressive movements, but we'll see if that low can hold. I mean, if somebody's looking just on a very, very short-term basis to see how this trend may pan out, yeah, I mean, you don't want to see the Dow go to a new intermediate low here below the 33,131. My guess it probably will, and eventually it'll stop, and you'll get a pretty decent market rally that probably is, going to last 3 weeks and probably recoup, 3 to 7% of the previous decline. So that's kind of what's happening now. I think it's very premature to kind of look at day-to-day, daily moves and try to determine that, hey, Dow theory has turned bullish. It just doesn't work that way. And
especially considering,
I think that's one of the strengths.
Especially considering, I mean, we're seeing what it confirmed is a major shift. I mean, that confirmation has, it's a major shift from bullish to bearish. So you got to think that it's going to take a little time to shape out. Just for the sake of argument, right now, though, what are those lows that you are currently watching that will probably take out? Let's talk about transports first.
The recent low, and I'm sorry to interrupt you, the recent lows that are worth watching just to kind of see if they can provide any kind of support here. On the Dow Jones Industrial Average, that recent low is 33,131. It's the February 23rd low. So that's 33,131.76. And on the Dow Jones Transportation Average, that low would be, and I will get that here in a moment, that low is also the February 23rd low. It's 14,523.47.
So those are technically, I mean, they could, obviously bust through and move lower and whatnot, but just to kind of reestablish things, those are the most recent lows. So those are the bottom
That is correct.
Right now.
Correct.
Yeah.
Those are the bottom right now. And again, whether those can hold, time is going to play a part of that. Again, if you and I are having this conversation 3 weeks from now, and those are the lows still, then I would feel more confident saying, okay, those are the lows right now. Let's see if we get a decent rally, and maybe we have had one between now and 3 weeks from now, and then see if those lows hold again, and then if that rally move that occurred gets taken out to the upside, that would signal a change in the trend from bearish back to bullish. And you make a good point. Typically, when you get these changes in the primary trend, because a Dow theory requires a series of confirmations to make those changes, they tend to be significant, and they don't tend to get reversed in 5 days, 2 weeks, 4 weeks. They tend to last for a while. Now, there has been serious time compression over the last several years with bear markets where they have not dragged on, fortunately, for 12 to 18 to 24 months.
And I want you to hit on that. I want you to explain why that is. We talk about time compression all the time. Explain what has led to that and what you actually mean by that.
Yeah, well, what I mean by that is, time compression, meaning that things, market moves that historically would take 8 months, 12 months, 24 months for a market to peel back 15, 20, 25%. We can see those in a much shorter time frame, and part of that is driven by just the frictionless movement of money now in the market. In terms of with a press of a button, you can move literally billions of dollars, and you can do it through trading vehicles such as exchange traded funds and things like that, which didn't even exist in a big way 15 years ago, 20 years ago. So it is much easier to push money around quickly, and thus causing these types of more violent moves as time compression. So, you go back to, when the pandemic first started and the market just cratered in March of 2020 now, I guess that is. The Dow Jones Industrial Average fell about 11,000 points in 27 trading days. Now think about that. 27 trading days, Dow Jones Industrial Average fell 11,000 points. That's violent time compression.
Right.
That was also maybe the shortest bear market on record. So, I don't want to discount if somebody says, well, can this thing be all wrapped up in 4 weeks? Sure. I don't think it's a high probability that that's the case. But is it possible? Yeah, it could be possible. I don't think that's going to be the case, but it has happened in the past. Typically, though, I would think that, instead of your 8 to 12 to 24-month bear markets, you're probably, time compression is probably going to take it down to, 4 to 8 months. So, hopefully before the end of this year, the trend would have changed back from bearish to bullish. But we'll have to wait and see. The one factor that potentially can be the biggest sticking point in all of this is, the nature of this bear market signal is occurring at a time when we haven't seen it in previous bear market signals in the last really 20 years. And it's not the Ukraine-Russia issue. It's the fact that inflation is running as hot as it's running. The fact that inflation is kind of an accessory to this bear market signal is something that does give me pause, because inflation can get real ugly in terms of with stocks, particularly if you have inflation with an economy that's starting to roll over.
Oh, so you're concerned about a lot of, maybe this is a sign of a lot of additional downside.
Perhaps.
Okay.
Yeah, I don't think this. Yeah, I mean, and hopefully I'm wrong. But this bear market signal, I don't think is necessarily a derivation of the Ukraine-Russia issue. I think, I hope it is, because those tend to be fairly short-lived, those types of reactions. But if I think the bigger issue that investors need to weigh, and the market is going to be weighing, is again, I don't think the Russian-Ukraine issue, but I think it's going to be, are we going to get into what's called a stagflationary environment? Are we going to see inflation still hot at the same time that the economy is rolling over and turning down?
Explain why that's so bad. We hear that stagflation. Talk about a bad scenario. For the Gaines listeners who aren't familiar with that term, just explain that real quick.
Yeah, it hasn't happened to the 70s, but in effect, inflation generally is accompanied by rising interest rates. So you've got rising interest rates, which increase the cost of money for people. You have rising interest rates, which make alternatives to stocks more attractive. And then you have inflation, which devalues the future, basically it erodes your spending power and erodes what you're willing to pay for growth. So now you've got a situation where you've got high interest rates, you've got PE contraction because people are paying less for growth. So you have PE ratios contracting. So valuations are contracting. Right at the same time, the corporate profits are getting killed because the economy's rolling over. And that is just a bouillabaisse of pain because you have a lousy economy. So, those three factors, Andy, that we talk about all the time that drive markets in a sustained way, interest rates, inflation, and corporate profits. Stagflation is the trio of pain there, because now you've got rising interest rates, bad for the market. You've got falling corporate profits, bad for the market, and you've got rising inflation, bad for the market. So it's that that is the triumvirate of badness for stocks. So that's what you don't want, and that's a fear that here you have inflation clearly rising and on the negative side of things. Corporate profits still are hanging in there, and you would still probably put them on the bullish side of the ledger. And you've got interest rates that are probably neutral. But if you get into a situation where, interest rates start to rise, the Fed certainly is going to do their best to increase interest rates next year or this year to reduce inflation. But in the process of doing those rates, do they tank the economy? Then you got some real problems. And that is the one issue here that gives me a little pause in saying, well, we're going to see the same time compression, and this whole thing's going to get wrapped up in 4 to 6 months. It could. I hope it does. But that is the one thing that does concern me out there. That concerns me much more than Ukraine, Russia, quite frankly.
I think that, a lot of people who follow markets realize that, inflation and some of these other factors are a much bigger deal economically than Russia, Ukraine. We're going to take a break real quick here. And then when we get back with Chuck, we're going to talk about the play. Just wanted to recap those levels now, those new base levels that were put in on the 23rd, February 23rd. That transports level, 14,000.
Transports levels, 14,523.47.
Yeah, 14,000. No problem. 14,523.47. And then go ahead, that 33,000. The industrials, go ahead, give that.
Yeah, and the industrials, same day. It's the February 23rd low. And that low was
33,133.76.
Correct.
Yeah.
33,131.76.
See, I'm taking notes. I'm hanging on every word that you say, Chuck. Hey, real quick, be sure to subscribe, follow, leave us a 5-star review on Apple Podcasts. And as always, subscribe and turn on those notifications so you know when a new episode drops. We drop Gaines episodes on Tuesday and Thursday afternoons. We'll be right back with Chuck Carlson to talk about the play with the Dow theory currently being bearish. We'll be right back.
If you enjoy learning about Chicago and its communities, culture, and people, you will love Shades of the City. It's a new podcast from News Radio, WBBM, and Odyssey, hosted by me, Lauren Brown. where I pass the mic to the people and allow them to tell their stories their way. Subscribe now on the Odyssey app or Apple Podcasts, and stay tuned every other Friday starting March 11th for new episodes.
All right, back with Chuck Carlson, CEO of Verizon Investment Services and publisher of the Dow Theory Forecast newsletter out of Hammond. And he's also the author of the book, Winning with the Dow's Losers. Real quick, I know you always give this website. It's great for the Gains listeners. It's on high growth stocks. What's that website? Give us that information, Chuck, real quick.
Sure. It covers small cap stocks and some mid cap stocks as well. And then that newsletter is Upside, and the website to go check it out is upsidestocks.com. Upsidestocks.com.
So be sure to check that out. All right. So now when we talked about the Dow theory and we mentioned those two levels, the base levels that were put in on the 23rd, the transports, 14,523 and change. The industrials, 33,131 and change. So those are the base levels that we're looking at now. What is the play here? Do you dollar cost into a Dow theory that's indicating a bear market? Do you wait for things to settle and turn positive before you start buying? If you have a lot of money that's, dry powder, we always say, on the sidelines, what do you do there? So how do you kind of play the Dow theory when it just turns bearish, and how do you maximize? Because ultimately you want to buy when stocks are on sale. So when this eventually does come back, I mean, and we always talk about this too, you really make hay in these down markets. So what's the play here, Chuck?
Yeah, I think the play, again, I wish I could say this is the play. The fact of the matter is everybody's a little bit different because everybody has a little bit different investment time horizons, et cetera. I think that in general terms, the play is raise some cash. And again, how do you do that? Well, I think you go through your investments, and, if you're, what we do, for example, is let's say we have an account, an investment portfolio that we typically run fully invested or near fully invested in stocks. We may take that down right now to 80 to 85% equity. So again, we're not making a huge all or nothing bet, and I would recommend don't do that, because you may get lucky and you may feel good when the market's going down, but you kind of get back in, especially if you're somebody with a longer term time frame. And all or nothing bets really make it difficult for people to get back in because they become very nervous about getting money back in. What we do is try to do two things. One, try to play a little bit of defense so it cushions. It doesn't eliminate, but it cushions the downside blow. But more importantly, it gives you some cash to be able to go out and buy some stocks. Now, the question is, when do you buy? Well, I think this idea of portfolio upgrading should be done all the time, and that's the case where, let's say you target now 80 to 85% of your portfolio in equities. That doesn't necessarily mean you don't do anything at that point. What it does say is, listen, if you see a stock that you like that has come down and it's better than one that you have in your portfolio, do the trade, swap out, sell the one and buy the other, keeping your equity exposure pretty consistent. At some point in here, and I think it's again too early, there may be an opportunity then to start to put that 15 to 20% that you pulled out, start putting that back in as well. But again, I would typically be more inclined to kind of wait to at least see if recent lows hold for any extended period of time. Yeah, does that mean you're not going to be buying at the exact bottom? You may not be, but that's okay. If the market is going to make a turn in earnest and you have a change from bearish to bullish, the fact is, if you buy something and you're buying it, 5 points off its bottom, you're going to still make a lot of money over time, because it's, if it's a true trend change to bullish and it's a quality stock, yeah, maybe you didn't buy it at the bottom, but you're going to do just fine. You're still probably going to be buying it 10, 15% off its peak, or maybe 20%, and you're going to make money over time. So, the best thing is continually upgrade. Keep in mind this concept that you only have a certain amount of money And you want to make sure that amount of money is always invested in your best ideas, and your universe of best ideas could grow as the market pulls back, as more and more quality stocks are coming down. That's the play. It isn't necessarily going out now and, we've got a market that is sold off and let's go buy the heck out of it. Now, if you're somebody that was running a portfolio pretty fully invested, now, on the other hand, if you're somebody who's been sitting in cash for, waiting and waiting and waiting, and you don't have any exposure to the market, then you probably should go out and get a little bit.
And if you're a newbie,
of the pullback here,
and if you're a newbie, I mean, talk about a time to start investing.
Right.
That would be like, just real quick. I mean, most of the Gains listeners, I'm sure, are probably exposed to stocks already. But if you are just starting to invest right now, boy, I'll tell you what, this is an opportunity to get started, and there's not a ton of downside risk when you start buying at these levels. Explain that real quick.
And especially if you have, if you're somebody, you're in your 20s or your 30s, and you got a 30, 40 year investment time horizon, I'm not sure you should be, putzing around too much other than, okay, let's put some of this money to work. And if you're concerned about dropping it all in at once, then, use this idea that Andy mentioned of dollar cost averaging, where you say, listen, I've got, I've got $10,000 or $20,000, and I want to put that in the market. Set it out, and you're going to say, listen, I'm going to get it in there over the next 12 months. So 12 months from now, that money's going to be fully invested. And then basically put in, break it up into 12ths and put it in once a month. And if for the next 12 months, and if you get a situation where the market really sells off, accelerate it, and maybe you put in 2 months worth in a month. But get in. I mean, don't worry about, oh, geez, I may put that money in and it's going to go down. I mean,
even if your time horizon was like 5 to 10 years,
you can still do just fine.
There
haven't been many, if any, 5 and 10 year rolling periods in the stock market where you would have lost money investing. So, you don't want to try to get too cute. You don't want to try to figure out you're going to pick a bottom and get all your money in its bottom, because that never works.
And you'll never get back in if you try to pick a bottom. I mean, just somebody who's been in the market for years. This is, we talk about it all the time. Boy, I'll tell you what, people get out of the market and then they just never get back. And I think, go ahead, I'm sorry.
Well, because two things happen. One, the market starts to go up and a person doesn't want to get in because when the market's going up, I'll wait for it to come back. And let's say the market keeps going down. Well, I don't want to get in because the market's going down. So you never get in. So, the best, especially if you're somebody new, you have some cash, you're probably not going to catch a bottom, but today's a whole lot better time to get in than it was 3 months ago. So, you got to start feeding it in, and however you can do that in a palatable way to you, do it. And dollar cost averaging, isn't perfect. I mean, research says, the biggest ally you have as an investor is maximizing the power of time. And the way you maximize the power of time is get as much money into the market as possible and take advantage of time. Well, that, in theory, that's great, and the research indicates that's the thing to do. But the fact of the matter is, emotionally, it's very difficult to do because you're just going to feel like, geez, I'm plowing all my money and it's going to be at the top. So split the baby and dollar cost average and say, listen, I'm going to be putting X amount of money into the market each month. And, if the market's high, I'll be buying less. If the market's lower, I'll be buying more. But I'm going to get that in there, get that to work for me, and you'll be way ahead of the game at the end of the day.
And as we wrap up today's Gains podcast, what's your takeaway from, where we're at, where we're going? I've actually been waiting, just personally, we've got some dry powder. I've been kind of hoping that the Dow theory would go bearish, because in the past, when it's happened, it's always panned out really well. So I see this as a real opportunity. And I'm sure you do as well. But parting shots and thoughts, regarding this opportunity.
Yeah, I think there's an opportunity there. I don't think necessarily patience is going to be a bad thing here. I think we're still if it's a 9-inning game, I kind of think we're probably still in inning 3, 4 maybe, if I had to pick an inning. So I think there's going to be time here. I wouldn't get greedy and say, well, I'm going to pick that bottom. If you see some stuff that you've really liked and it has come down significantly, putting a toe in the water in that. Maybe if you were going to buy 300 shares, ultimately you wanted to own 300 shares, go buy 100 of it now. But I think that there will continue to be a bit of pressure on the downside here, at least. Like I said, I think there's a few more innings left of some weakness here, and we'll have to see how things pan out. But, the biggest thing is stay engaged, stay focused, and be willing to kind of take advantage of these opportunities when they present themselves.
I have just 2 quick things I wanted to, as we wrap up the show. I just wanted to get your comment on this. I like the Gaines audience to kind of get a feel for, to understand our guests. First 2 regular season series for Major League Baseball canceled. Does that concern you at all? And are you a Cubs or White Sox fan?
Yeah, it bums me out. I'm a longtime baseball fan. Shoot, Andy, I still play fast pitch baseball in a 30 and over league.
See, I didn't know that. I'm glad I brought that up. So, are you a Sox or Cubs fan?
Well, I'm not originally from Chicago, so I don't have a dog in that fight. I like to see both of them do well. I had a great time when the Sox won it in 05, and certainly had a great time when the Cubs won it. I suppose when the Cubs play the White Sox, and if I had to pick a team, I would pick the Cubs. But I'm not one of those all or nothing, diehard Chicagoans that grew up and either, you're a South Sider or a North Sider, and that's the way you go. So I like to see both of them do well, quite frankly.
Very nice. I mean, if you were going to have a World Series winner, though, who would you like?
The Cubs.
Oh, the Cubs. Okay. I, on the other hand, I'm a White Sox fan, and got to tell you, full disclosure, love the White Sox winning the World Series at 12-1. Plus 1,200 on that. I like that.
I think they'll be a much better team this year for sure. I think the Cubs struggle. I think the White Sox have a pretty attractive team, and I think you're right. I think they can. Hopefully they can contend this year. Hopefully we'll have baseball to see them contend.
Yeah, the Cubs, it's not looking good. I mean, you're basically looking at 100-1 odds. They're down there with such powerhouses like the Baltimore Orioles, Pittsburgh Pirates, and Texas Rangers. So that's interesting, though, real quick. So you still actively play baseball for in a men's league?
I do,
what
Andy.
Position?
I have a pitching machine set up in my pole barn with a batting cage. That's how...
That is awesome. That is outstanding. And then, that's almost too good. I'm so glad we touched on that. And then one last other thing. You had a ham sandwich for lunch today. And, I'm a Hellman's guy. And you mentioned something about Duke's Mayo. And you said this is like next level. So just a real quick comment on that. That kind of caught my ear when you mentioned that.
Oh, yeah, no. There's no comparison. It's the best mayo out there, Duke's. DUKE''S. If you like mayonnaise, I know some people don't. If you do, put away that Miracle Whip. Nobody really knows what that is. And let's go with Duke's. Solid. It's available in most stores, too.
I'm a Hellman's guy, but I think I'm going to make a shift and try Duke's out. Well, hey, it's always great to have you on, and thanks for having a little fun with me at the end of it. That's
Chuck. Anytime, Andy. It's always a pleasure.
That's Chuck Carlson, CEO of Horizon Investment Services and publisher of the Dow Theory Forecast newsletter in Hammond, Indiana. He's also author of the book Winning with the Dow's Losers. One last time, give us that special website you always provide for the Gaines listener.
UpsideStocks.com. You can go there and get a free 30-day trial subscription to our Upside newsletter.
All right. Well, you go and go back to that pitching machine and start practicing on your swings because your season's going to be starting real soon, maybe before the MLB. Thanks again, Chuck. Hey, be sure to subscribe, follow, leave us a 5-star review on Apple Podcasts if that's an option for you. And always, as always, subscribe and turn on those notifications so you know when a new episode drops. We are back on Thursday, and I look forward to seeing you then.
A News Radio WBBM podcast powered by Odyssey.